This part mainly relates to adjustments mainly made for stock options, because as you all know, when you have a long position in a stock, you may be receiving dividends. And what happens usually when you receive dividends? What will happen is that the price per share will decrease by the value of the dividend. Now, this is usually something good for put options holder, and it's not that good for call options holders, because mainly calls and puts are not adjusted for cash dividends. So usually when there's a large dividend will lead to a significant decrease in the price, which means that the value of the put option will increase while that of a call option will decrease. And you will see later on when we will discuss the early exercise conditions for call and put options, we will see how those decisions may be affected by a large expected dividend. How a large expected dividend may lead us either to delay exercise or to exercise early an option. Now for splits and reverse splits, calls and puts are adjusted to reflect such splits. So for example, if we had a 2-to-1 stock split, this means that now for each one share at, let's say, price P0, we have 2 shares, each at a price P0 divided by 2. So mainly if you had one share worth $100, you will have now instead 2 shares at $50 each. Yes, so now the adjustment is similar to what's happening with the stock. So for example, for the call or the put, so for the options in general, the option initially it covers 100 shares. So each contract covers 100 shares. In case we had a 2-to-1 split, and initially this is the strike price X, this is the initial strike price, this is before the split. After the split, we will have the following. The contract, whether it's a call or a put option, the contract will cover now 200 shares. And the new strike price is X divided by 2. And mainly the general case, the one that we can see here on the slide, is that the strike price is adjusted for stock splits. So when there's an N for M stock split, the strike price is reduced to M times K divided by N. In the example that I've just provided you, N was 2 and M was 1. So the strike price was reduced to 1 times K divided by 2, which is equal to K divided by 2, or X divided by 2. Now, the number of shares that can be bought in case of a call or sold in the case of a put option is increased to N times N divided by M. So in this case, 2 times 100 divided by 1. Now for a stock dividend, because sometimes companies may decide instead of paying cash dividends to pay stock dividends. So in this case, a stock dividend is handled in a manner similar to a stock split. So in this case, like for each, for example, 4 shares, you may receive an additional share. This is an example of a stock dividend. So it's considered a type of stock splits if you want. Now consider a call option to buy 100 shares for $20 per share. How should terms be adjusted if we have a 2-to-1 stock split? And of course here the split that will happen to the option is related to the split that happens to stock. So whether it's 2-to-1 or 3-to-1 or 3-to-2. So it depends on the stock split. The adjustment is based on the stock split. So in this case, if we have a 2-for-1 stock split, the call will be now to buy 200 shares instead of 100. However, the strike price now, instead of $20, the new strike price is equal to 20 divided by 2 is equal to $10. So this is the adjustment that we need to do. Now, let me add here another example, like for a stock split. That's a more complex case. Let's say that the stock split was, for example, 5-to-2. So each 2 shares, they're now equal. Now each 2 shares are after the split 5 shares. So in this case, the call covers 100 shares times 5 divided by 2. So 250 shares. The strike price X is equal to 20 times 2 divided by 5 equals to 8. So this is in general for any stock split, and as we've seen before of the form N divided by M, the number of shares I multiply by N over M. For the strike price I multiply by M divided by N. Now for a 5% stock dividend. So in this case, what will happen is that it's similar to having a stock split of 1.05 to 1. This means for every 1 share, I will have now 1.05 shares. So in this case, the call will cover now, instead of 100, it will cover 100 times 1.05 divided by 1. So it will cover 105 shares. Regarding the strike price, the new strike price X equals 20 times 1 divided by 1.05. So you will have 20 divided by 1.05 as the new strike price. Okay, now like regarding the mechanics of options trading, mainly you have market makers or dealers in options markets. So most exchanges, they use market makers to facilitate options trading. And the market maker will quote bid and ask prices when requested. And here you will see that the bid and ask spread is much more significant than that for stocks. So mainly for heavily traded stocks, you will have a bid and ask spread of 1 cent, let's say. Here, the bid and ask spread, like for heavily traded options, is usually 0.05 per share, which translates to $5 per contract. So mainly, once you enter the contract, it's like you're already losing $5 due to the bid and ask spread. For options that are deep out of the money, and I will mention soon what do I mean by deep out of the money. So just as a quick example, if the current price P0 is equal to $100, and you have an option with a strike price X of, let's say, $150. So in this case, you will need the price to increase by 50% so that this option is in the money and can be exercised. So this option is said to be deep out of the money. For those options, the bid and ask spread is gonna be like very wide. For example, it can be 0.05, 0. For example, 55. So if you want to buy this option, it will cost you $55, which is 0.55 times 100. If you want to sell it, you can sell it for only $5. So as you can see, it's a $50 spread. Now, because options are mainly highly leveraged instruments, and they pose a lot of risk on the part of the party with the short position. Therefore, the party with the short position is supposed to post margin. So now, when you have an uncovered call, what we call a naked call option, and a naked call option, this is when you sell the option. So you take a short position in the call without having a long position in the underlying asset or in the stock. So if, for example, you had a short call and a long stock, this is gonna be called a covered call. In this case, there's no risk if, let's say, you short one contract and you own 100 shares. So in this case, there's no risk because you own all the shares that are gonna cover your short position in the call. However, if you have only a short call without having a long position in the stock and offsetting long position in the same quantity covered by that option, this is called a naked call or an uncovered call. And this is one of the riskiest position that an investor can take. So now when the investor shorts a call, an uncovered call, the margin is the greater of the following: a total of 100% of the proceeds of the sale plus 20% of the underlying share price less the amount, if any, by which the option is out of the money. Now, of course, those cases are going to be more clear with examples and with problems and assignments. Or a total of 100% of the proceeds of the sale plus 10% of the underlying share price, exercise price in case of a short put. So if it's a call option, this is going to be 100% of the proceeds. So let's say that when you take the short position, you take the short call, you receive, for example, $250. So the price per share is $2.5. So here for number 2, it's 100% of the proceeds, so it's $250 plus 10% plus 0.1 times the price per share. the current price per share, let's say that P0 is, for example, $40. So in this case, plus 0.1 times 40. But here we need to remember that this is like for one share. So mainly when you have 100 shares, you need to multiply by 100. Or if I'm putting it as per share, it's gonna be like this, 2.5 plus 0.1 times 40. This is the required margin per share. For if this was a put option, instead of putting here $40, the price, I should put the exercise price. For one, it's gonna be 100% of the proceeds plus 20% of the underlying share price less the amount by which the option is out of the money. We will see more about how to compute such values, how to determine whether an option is out of the money and by how much. Okay, so in the following slide, I'm gonna cover the moneyness and the intrinsic value of an option. How to determine whether an option is at the money, in the money, or out of the money. So mainly moneyness refers to the value of the option if it were exercised immediately. So now, if the option is exercised immediately and the payoff of the option is positive, this means exercising the option will result in a profit. The option is said to be in the money. Now, if the option is exercised and the payoff is negative, and as I said before, mainly the broker won't allow you to exercise such an option, but like let's assume that if it's exercised, the payoff is gonna be negative. In this case, we can say that this option is out of the money. And finally, an at the money option will have a payoff of 0. So the investor is gonna be indifferent whether to exercise or not that option because its payoff is 0. So let me give you a quick example. So let's assume that we have a call where the strike price X is equal to 100. Now an example of an in the money option is when the current price PT or ST is, let's say, equal to 107.25. In this case, if you exercise the option, you have the right to buy at 100. So you buy at 100 and you sell at 107.25. So you have a profit of 7.25, or you have a positive payoff of $7.5 per share. This is greater than 0, so I can say that this call option is in the money. If let's say for the same strike price X equals 100, if ST was 96.81, in this case, if I exercise the option and buy at 100, I need to sell at 96.81. In this case, the payoff is gonna be negative, so minus 3.19 less than 0. So I can say that this option is out of the money. Finally, for the same strike price, if ST is equal exactly to 100. In this case, the payoff of the option is 100 minus 100 equal to 0. So I can say that the option is at the money. For the put option, if I have also X equals 100, if ST was equal to 107.25, with the put option, you have the right to sell at the strike price at 100. So the payoff is 100 minus 107.25. This is negative. So I can say that this option is out of the money. Now, in case the price was equal to 96.81, the payoff is 100 minus 96.81. This is greater than 0, and I can say that this option is in the money. And finally, if the price is equal to $100, equal to the strike price, this means that the option is at the money. So now, for the conditions, an option, whether it's a call or a put, is at the money if X is equal to the stock price, to S0 at time t equals 0, or to ST at any point in time between time equals 0 and the expiry date of the option. Now, in case X was less than S0, like in this first case here, so I will call it 2. This is number 2. So this is case number 2, where I have X is equal to 100 and S is equal to 107.25. In this case, the call is in the money, while the put is out of the money. So this is when X is less than S. Now, when X is greater than S, this is case number 3. You have S equals 96.81 less than 100. So in this case, the call is out of the money, and the put option in this case is in the money. Now, of course, you do not have to memorize like the condition, because this is intuitive. You can directly tell under which conditions a call or a put is in the money or out of the money or at the money. Simply, you need to remember the definition of each option. So for the call, it's the right to buy at X, the strike price. So when you determine the payoff, you will have minus X, because you're gonna pay the price X and you will be selling at the market price S. So for this option to be in the money, S minus X should be greater than 0, or S should be greater than X. So this is the condition to have an in the money call option. Now, the intrinsic value is mainly the amount that is in the money. So for the first case here, the call is at the money, the intrinsic value is equal to 0. And in case the call or the put were out of the money, also the intrinsic value is 0. The intrinsic value is always greater than or equal to 0. In the case where I have the call that's in the money, like in this case, the intrinsic value of the call is this $7.25. In the case of the put option that's in the money, like in this example, it's the difference between 100 and 96.81. So it's 3.19. This is the intrinsic value of this put option. Now, the intrinsic value of the put option that's out of the money, this one, is equal to 0. And for this call option, the intrinsic value is 0, because under no circumstances a party with the long position in an option will have an obligation to exercise. So simply, when the option is out of the money, the holder will decide not to exercise. So the intrinsic value is gonna be 0. It can never fall below 0. Now, the option value or the option price at any point in time is equal to the intrinsic value of the option plus its time value. And here the time value is different than the time value of money concept that you all learned in managerial finance. So the time value here means this is the time remaining to expiry. So the longer the time to expiry, the higher the expected volatility in the stock price. So the stock price can increase further to benefit, let's say, a call option holder, or it can decrease further to benefit a put option holder. And the longer the time value of the option, the higher the option value. Now, as we approach the expiry date, so let's say I'm moving here from t equals 0 till t equals 1. So it's 1 year, let's say. So if the option expires after 1 year, the time value is the highest here at time t equals 0. As I'm going and approaching the expiry date, the time value of the option is going to be decreasing over time. Once I get to the expiry date, the time value of the option is gonna be equal to 0, and in this case the option value is gonna be equal to its intrinsic value. Now, what are the payoffs and profits of long positions in options, whether it's a call or a put option? For a call option, this is the right to buy at X. It means that we will pay X and sell at the market price S. So now, if S minus X is greater than 0, we will exercise. If S minus X is less than 0, we will simply decide not to exercise. So if S minus X here is less than 0, we will decide not to exercise, and the payoff is going to be 0. So in this case, I can say that the payoff of the call option is the maximum of those two values, S minus X and 0. If S minus X is positive, if the option is in the money, I will receive S minus X. So this is when the option is in the money. If the option is out of the money, I will choose not to exercise, and I will get 0 for my payoff. So this is the payoff. The profit, I should consider the premium I've paid for that call option. So the profit on my position is mainly the payoff, the maximum of S minus X and 0, minus C, which is the price of the call option, the premium I've paid to buy this call option. Now, the decision to exercise or not has nothing to do with the profit. So when I consider whether to exercise or not, I do not consider the call price, because simply the call price is something, is an amount that I've already paid at time t equals 0. So let's assume that C is equal, for example, to $7. The strike price X equals 100, and the stock price is equal to 105. So now in my decision to exercise or not, I do not consider this $7. This amount is already paid. What I'm gonna consider is the difference between S and X. So I have S minus X is equal to $5. It's greater than 0. So in this case, I can exercise. And this is assuming that we did reach the expiry date. Because as we're going to see later, at any point in time, especially for the call option, the price of the call option in the market is greater than its intrinsic value, because the time value of the option is always greater than or equal to 0. So now, when I exercise the option, I will be receiving $5. So I can say that the payoff is 5. However, my profit is 5 minus 7 minus 2. So I'm still losing $2. But losing $2 is better than losing $7 if I decide not to exercise. So mainly when you exercise, you need to look at the payoff, not at the profit. If the payoff is positive, you should exercise. This way you will be either minimizing your loss, like losing $2 instead of 7, or you may end up with a profit. If let's say the price was 110, in this case you may end up with a $3 profit. Now regarding the put option, the put gives you the right to sell at X. So you sell at X, it means that you will receive X. You will receive plus X, and you can buy at the market price S. In case X minus S was positive, you're gonna exercise your put option. In case X minus S was negative, in this case you will choose not to exercise and you will have a payoff of 0. So the put option payoff is the maximum of X minus S and 0. The profit in this case is the payoff minus P, the price of the put option. Now, if I want to move to the parties with the short position. Now, the party with the short position will have exactly the opposite payoff of the party with the long position. So the party with the long position, the payoff is the maximum of ST minus X and 0. Therefore, the payoff of the party with the short position, I simply add a negative sign, or I multiply by minus 1 to get the payoff for the party with the short position. So I can say that the payoff of the party with the short position equals the payoff of the long position times minus 1. And the same will apply to the profit. I will also multiply by minus 1. Now, minus the maximum of ST minus X and 0 is equivalent to the minimum of X minus ST and 0. So in this case, I can say that the call option profit is equal to the minimum of X minus ST and 0 plus the call premium. So let's have an example about the payoff and the profit of the short, the party with the short position. So here we have a short call. Let's say that C is equal to $4. Let's say that X equals 100. And here I will take two different scenarios. The first scenario is that S is equal to 103. The second scenario, S equals to, let's say, $95. So let's see what's the payoff and the profit for the party with the short position under each scenario. Now, under the first scenario, the party with the short position will not decide whether to exercise or not. So in the best case, it's 0. Because remember, this is the party with the short position, this is the party with the long position. At time t equals 0, the party with the long position will pay the premium, will pay this $4 to the party with the short position. Later on, there are no cash flows from the short position to the long position. The only cash flow that can happen is from the short to the long. So the best case scenario for the party of the short position is that there's no such cash flow. In this case, it's zero, or it can be negative for the party with the short position. So it's mainly the minimum of x minus s and 0. 0 in case there's no exercise. In case there's exercise, it's x minus s. Now, why it's x minus s, not s minus x? Because the party with the long position will buy. So for the party with the long position, it's gonna be s minus x. For the party with the short position, will sell at x. So it's gonna be x minus s. So in this case, you have x minus s. I have 100 minus 103 and 0. So the minimum of those two values. 100 minus 103 is minus 3. So between minus 3 and 0, the minimum is minus 3. So mainly what will happen is that the party with the long position will decide to exercise because the option is in the money. So the party with the long position will buy at 100 and sell at 103 and make a $3 as a positive payoff. For the party with the short position, will have an obligation to sell at 100 and buy the share at $103, which will result in a payoff of minus 3 or a cash outflow of $3. Now, if I consider the profit for the party with the short position is minus 3 plus C plus $4. So minus 3 plus 4 is equal to plus 1. So still, the party with the short position ended up with a profit of $1. Now, in the second scenario, where S is equal to 95. In this case, the party with the long position will decide not to exercise. So in this case, you have x minus s is 100 minus 95 is $5. So the minimum between 5 and 0 is 0. So the payoff is 0, and the plus the price of the call plus 4, it will give me plus $4 as the profit of the party with the short position in the second scenario. Now, for the put option, it's the same, and later on, once we get to the strategies, I will always give you this advice to treat the short position as if it was a long position, then simply multiply it by minus 1. So mainly you do not need to memorize those, like what's the put pay option, payoff, the minimum of ST minus X and 0, or what's the profit of a put option, a short position and a put option. You simply need to care about the long position and then simply multiply by minus 1. Now for the main transactions and options, I will start with call options. So let's say that an investor buys an option at time t equals 0. So at time t equals 0, we take a long position in an American call. Now, at any point in time between time t equals 0 and capital T, which is the expiry date, at any point in time here, the investor can do one of the following. The investor can either exercise, so this is the first case, the investor decides to exercise the option by buying 100 shares at a price X per share, and then selling those same shares at a price ST. The second case is that the investor cancels the position by selling the call for 100 times CT dollars. So in this case, you sell the position, you sell the call option, and you close your position. The third thing that you can do is that you can keep holding the call till you reach the expiry. So you can either exercise the option, sell the option, or keep holding the option till expiry. Now, once you reach the expiry date, once we reach capital T, at this point in time, the investor has two options. Either to exercise if S minus X, if ST minus X is greater than 0, or not to exercise if ST minus X is less than 0. Now, when ST minus X equals to 0, it won't matter. So whether you exercise or you do not exercise, it won't matter because your payoff is gonna be exactly 0. In this case, what's your maximum loss if you are holding this option? Your maximum loss is gonna be realized when you do not exercise, when we reach the expiry date and the option is out of the money. So in this case, we can say that the option expired out of the money. So the loss for the investor in this case is mainly the price paid or the premium paid for that option, which is 100 times the call premium or the call price per share. So this is gonna be the maximum loss for the party with the long position. Now for the seller of this option, the party with the short position on this call, the seller is obligated to deliver 100 shares of the underlying in exchange for 100 times X dollars. So now, what can the writer do at any point in time between time t equals 0 and the expiry date? The investor can either close out the position by buying a call option to close the short position, or simply decide to do nothing, to keep waiting till the expiry date. Now, once we reach the expiry date, as I've said before, it can be that there's an exercise or no exercise. In this case, if there's no exercise, this means that the party with the short position will realize the maximum profit, which is the premium. The premium collected at time t equal 0. In case there's exercise, the loss potential for a short call, a short uncovered call, is unlimited loss potential. So this is the maximum loss. It can be unlimited because we cannot put an upper limit on the stock price. And this is what we've said when we've covered margins, is that maximum loss is unlimited. So margins must be posted to guarantee payment in the event of an exercise. And naked positions are short positions in an option that are not combined with a position, with a long position in the underlying security. Now, in this case, why here we are saying it's not combined with a position in the underlying security, because mainly a covered call can be constructed by having a long call, a long stock with a short call. If you want a covered put, this is when you have a short position in the stock and you take a short position in the put option. So both of those strategies or both of those positions, they are covered positions, whether it's a call or a put. So the idea is that you need to combine them with the underlying asset. Now, if it's a covered call, it's covered through having a long position in the stock. If it's a covered put, you are covering your short position in the put by a short position in the stock. Because here, like, it's easier to look at it when it's a covered call, because with the covered call, if the stock price increases, and this is a covered call, what will happen is that you will have a loss on the call, but this loss on the call is gonna be offset by profits on the stock. So those two, they will offset each other. If I go to the second case, the case of a covered put. In this case, if the stock price decreases, what will happen in this case on the put? You will have a loss on the put, because the party with the long position will benefit when the stock price decreases. However, if you have at the same time a short position on the stock and the stock price decreases, this means that you will be making a profit on the stock. So those two, they will offset each other. Now, buying a call option is considered a bullish strategy. By definition, a bullish strategy is a strategy that will result in a profit when the stock price or the underlying asset increases in value. So a higher price, a higher stock price is gonna increase the profits of the position or of the strategy. In this case, we say that this is a bullish strategy, is that the investor will benefit from any appreciation in the value of the underlying. Now, the bearish strategy is any strategy where the investor will benefit if the price of the underlying decreases. So an example of a bullish strategy is a long position in the stock. This is a bullish strategy. A long call, this is a bullish strategy. And I can add here also a short put. Because in this case, if the price of the stock increases, this means that the put is not going to be exercised, and the investor will end up with the premium of that put option. A bearish strategy is like taking a short position on a stock, so short S, or long put, and finally short call. This is considered a bearish strategy, because when you short the call and the price of the underlying goes down, this means that the party with the long position will not exercise the option, and the investor can end up grabbing the premium of the option. So now, although buying a call option gives you an unlimited upside gain potential, however, it's still very risky, as you may lose all of your investments, especially that the option has a predetermined expiry date. So even if the stock price increases significantly, but that increase is after the expiry date, you won't benefit from such an increase. And mainly, like most long positions and options, they expire out of the money. However, when you make a profit on an option, it's gonna be a huge profit. Now, options can be used by speculators as leveraged stock positions, but they can also be used creatively to manage risk exposures. So we're gonna see later on in some examples how those instruments can be used by speculators and how they can be used to minimize risk, or like in combination to form a certain strategy, whether involving the underlying asset or involving other types of options. So For example, this is something we'll see after 2 chapters when we talk about option strategies. We will cover a strategy called a straddle. So with a straddle, you buy at the same time a call and a put option. So it's going to be a long call and a long put. Other strategies may involve buying one call and selling another call at a different strike price. So in this case, we call about a spread. We can talk about, let's say, a bull spread. So later on, we're going to cover such strategies.